Good evening, everybody. I hope everyone's had a fantastic day, whether it be the morning, the afternoon, or the evening. Thank you very much for all of the interest generated globally across the world with regards to Intelligent Trading Academy and ATFX in partnership with investing.com for this weekly webinar. The greatest thing is Intelligent Trading Academy produce several webinars for educational and analytical purposes across the platforms, primarily with investing.com and our preferred broker ATFX. So this evening we're going to be looking at mainly market structures through patterns and of course looking at frameworks such as trend following. Just before we do delve into the real meat and potatoes of who I am, who ITA are, and of course all of the educational material with some live chart work, and I may even get the opportunity for you to just have a glance at a couple of our open trades that we've got running and open in the portfolio and the book at present. Can everyone hear me loud and clear, please? Let me know, just type a yes in the chat box if you can. Super, thank you for those that have responded. Hope you've all had a fantastic day so far, and I hope positive mental attitudes are with us all. So let's get into this. So Intelligent Trading Academy, we're a global professional trading academy around London, Europe and South Africa. We are soon to be expanding into the UAE and Australia, in Melbourne in particular. Adrian and I, our own personal and professional experience spans over 40 plus years. Myself, I've been trading the financial markets now for 14 plus years, and Adrian over 25, 30 years alone. Adrian's worked for some of the biggest investment banks in the world, such as SocGen and Credit Suisse. He's very institutional. He's a massive trend follower that enjoys primarily actively trading trend following momentum strategies. He's managed accounts in excess of £250 million. He's a member of the Society of Technical Analysts, so he's an MSTA. He's also taught delegates to actually go through and sit their exams and actually pass their exams and help them pass their exams with distinctions. He's taught at the London School of Economics, which, if you're all aware, is quite a highly regarded university in the City of London. He's extremely disciplined and consistent in his trading and methodologies and his approach, and he's very experienced in risk management, educating and mentoring traders, as well as his own specific mindset. This is me. I've traded for 14 years. I'm a qualified technical analyst. I actually trade primarily trend following, but I utilize market structures, i.e. patterns, as well as the nature of a particular market. So basic Elliott wave theory, so impulse, correction, impulse. And I also incorporate the actual true price action into how I trade, just purely for execution, to ensure that I am getting in at the most efficient or high probability areas. I've worked within IDBs, one of the top 4 in the world. I've worked for wealth managers. I actually set up my own proprietary trading company, as well as my own hedge fund, which Adrian and I still run to this day. And I've also worked alongside global fund managers and managed in excess of over 100 million sterling. I'm a member of the CISI. I'm qualified in investment risk and taxation, and I'm very experienced in risk management, technical and fundamental analysis, and psychology and mindset, which I actively practice and preach daily in terms of affirmations, values, goals, meditation, and positive reinforcement and positive attributions and mental attitudes. Primarily because if we all look at it, and I'll show you ever so shortly, psychology makes up the biggest part of everyone's success. You know, if you only have to go and read a few books out there, the 7 Habits of Successful People, Consistency is Key, Think and Grow Rich by Napoleon Hill. And by the way, I'm not endorsed by anyone in particular that I'm mentioning above, but it just gives us an insight and a taster to what we need to be like, and more importantly, the secret and that's another good documentary on Netflix, and the book. I'm an active reader. I continuously read, study, and learn the markets. I believe thoroughly in back testing every single strategy. I back test daily, if not weekly, and I conduct advanced self-review at the end of every month just to see where I can tweak myself, my performance in my psychology and mindset, and as well as in my risk management and any positions. The greatest thing is the way I trade and the way we trade here at ITA. There are an abundance of opportunities in the marketplace, so there is no need for the FOMO, i.e. fear of missing out, and there is no need to chase the markets. So far, on my own personal trading strategy, which is the ITA manual strategy, we've taken 2 trades and we're sitting up about 7%, and I've missed about 3 trades personally, one of those being GBP Swiss earlier today, Euro Sterling, and earlier in the week I think it was NZD USD. All of those trades have been doing fantastically, but we're sitting up on those two positions just over 7% overall, and the other 2 trading strategies that ITA utilize are sitting comfortably as well, and I'll show you some of those open positions a bit later on. So delving a little bit deeper, and I always like to cover these particular areas first, because everyone that wants to learn how to trade primarily goes for the most easiest, which is actually the least important, which is trading strategy. Yes, we all need to find a trading strategy that suits every single one of us, that fits our capabilities, our lifestyles. If we have a full career or a working job from 9 to 5, we need a trading strategy that allows us to evolve and adapt and actually be traded around those hours relatively passively. So you'll find that the way I trade and the way we're going to cover this evening with yourself and educate and provide you some insights on, once you're prepared, you won't have the haphazard approaches, and in turn you won't get haphazard results. And over a period of time, if you put the work ethic and the time, the commitment, the discipline and the dedication in, you will see consistently profitable returns month on month, year on year. But a nice sentence to end on is: no one trade, one day, 1 week, 1 month, 1 year will define any single one of us as a trader. Ultimately, yes, we all want to make money from the financial markets, and it can be done, but it has to be done in the most professional, efficient and correct way. And if you're going to get an education or mentored by individuals, they need to have credibility and a professional track record, i.e. career. Have they been in the financial markets? How long have they been in the financial markets? Can they show you a live account? Can they show you open trades that are currently actively running? And do they back up what they say in terms of their experience? The greatest thing about both Adrian and myself, we use fusion analysis. So fusion analysis is the combination of technical and fundamental analysis. Now, technical analysis, yes, there are over 200 plus indicators, let alone the oscillators, the laggard indicators, the expert advisors, the alert systems, etc., etc. But Adrian and I have never been unstuck with a question, so please feel free to ask any question you possibly want to, be that about moving averages, be that about multi-time frame analysis, be it about top down, bottoms up, asset classes, be it equities, commodities, cryptocurrencies, debt, which is fixed income, energy, of course, which is within the commodity sector, or indices, or forex, currencies. Primarily here at ITA, we trade FX due to the liquidity, but of course we have traded cryptocurrencies, commodities, equities, indices and the likes as well, and we actively do so week in, week out. So we're looking actively across the multi-asset classes. But if we look at the pyramid in front of us, psychology and mindset can actually make up more than this, but I equate it to about 60% of every trader's success. And that's why I put so much importance on this particular area, because you not only need to understand who you are, but you need to understand the market. The market can stay irrational longer than any one of us here can stay solvent. But the way we get around that is understanding who we are and working on ourselves, tweaking it, and then of course doing a lot of back testing, doing forecasting. By back testing, you gain the understanding of your strategy, your edge, your strike rate of a particular currency pair, particular pattern, particular way it moves, be it impulsive, corrective, how deep those corrections are. You then, of course, build up that consistency. From the consistency, you will then, of course, develop and gain your confidence. And thereon, your patience. Patience is massively key. Sometimes I may only take 8 to 10 trades a month. This week, like I said, this month so far I've taken 2 trades. This week I haven't taken any. I'm flat, but our other strategies are running. And from all of those 4 or 5 points, then the profits and the success will come. So it does take time, but following the process creates the profit. Don't chase the profit because you negate and forget about the cycle of the process. Then comes risk and money management. So in ITA, we never risk more than 2% per trade, with an average usually around the 1% mark. Now, the reason that is because if we were to take 100 trades in a row, and let's say we took 20 trades that were losses, and the rest, i.e. the remaining 80, were mixes of profits and break-evens. Now, the profits were roughly 3 to 1, 4 to 1, or 5 to 1, and the break-evens were obviously in there as well. If we were to take 20, if we had a series of 100 trades and we lost 20 trades, yes, we know our edge. Yes, we know how confident we are that our strategy performs year in, year out. Yes, we're disciplined. Yes, we're consistent in our process and our approach. But what we don't know and what we cannot control is the way the market moves. We cannot control an outcome of a trade, and we cannot control price. So we do not know if we're going to take 10 losses in a row, 2 losses in a row, 20 losses in a row, 1 loss in a single occurrence. But what we don't want to do is lose the opportunity to trade. Now, bear with me here. Trading is, of course, ultimately about how much money you can make, but that's not the real reason. The longer you stay in the game, the more opportunity you get, the more experience you become, the more money you get under management, the better, the bigger you become. So whilst, yes, the end result is freedom, time, opportunity, money, all of those wrapped up in a ball come from staying in the game the longest. I've been in the markets for 14 years, nearly 15. If I look back to when I first started trading, I was always in a rush. The older I got, the more patient I become. And what I find, and this isn't trying to speak naively or ignorant to those that are more wiser and older than I am, but I find that the younger the people are, the less time they feel they have. The older the person is, the more time, patience and discipline they have. And it all comes from that life cycle. So from me being a younger individual, hanging around and socializing and networking with successful individuals, I did try to extract as many of their successful traits and a lot of their wiser sentences and paragraphs that they could provide and pass on to me. So I managed and had the ability to pick up that at an early stage of life. So it helped me to speed up my processes in terms of who I am, the processes, and becoming more patient. The more patient I became, the less trades I took, the quality the setups became, and I only focus on 80% high probability setups and 20% valid setups. And the least important is trading strategy. Now, if we just take one of the most successful investors in the world, yes, he's an investor or a trader, Warren Buffett. If you actually read his books, he does publish investment strategies and theses in his book. But the paradigm and the rhetorical question here is, how many successful investors and traders have been able to mirror that of Warren Buffett? The majority of people that have actually gone down that route have then been picked up by the entrepreneurial magazines, the Bloomberg magazines, the success magazines, as being the next Warren Buffett, who have then gone on to not be as successful. Yes, there are a couple of multi-billion-dollar hedge fund managers in there that were compared to Warren Buffett, but then they go and make a silly mistake on a pharmaceutical stock and lose 7 billion. Yes, you heard it right. A particular stock, pharmaceutical, Valiant Pharmaceutical, a particular investor invested long at about $192. It rallied up to about 211, 220, give or take around that big round number. He didn't sell out. Technically, the chart really started to scream sell as it moved down to the downside in a very bearish nature, impulse correction, etc. He finally got out at around $11, $7, and lost a lot of money from his investors. So even the greatest can remain ignorant and irrational in terms of market consolidations and periods and market cycles. So another wise little sentence there: do not become greedy, ignorant, or stay irrational, because the market can do it a lot longer and it will stay a lot more irrational than you can stay solvent. So thank you guys. Thanks for those that have just joined. I hope you had a really nice pizza Vincenzo. My favorite is Texas barbecue, but we won't drift into that. Vasco, nice there, mate. Well done. It's nice to see some people are on the ball. And yeah, big short on Herbalife. It was quite an interesting documentary on Netflix. If you haven't watched it, guys, again, not an endorsement, but feel free to watch it. Really interesting documentary, especially around the topic of Herbalife. So Vasco, just to clarify, cryptocurrencies, yes, I do believe it has a future. Not entirely sure whether it's the actual tokens, be it an asset-backed token or a security token or a utility token, that's going to have the real future. But primarily what I'm more interested in is the underlying blockchain technology. So the APIs, the nodes. Blockchain is realistically the key. Yes, if we look at certain tokens, especially Bitcoin, BTC, there's what, 21 million in existence. We look at gold, there's an infinite finite amount. So look at the raw value in terms of hedging. Look at transaction costs. There was a massive transaction processed in June. Yes, Bitcoin came off from 11,000 down to about 9,400, 9,500 early this morning. And there was a transaction last month in particular. I think it was 43,000 Bitcoin were moved in a single transaction. So put that in notional volumes, that was over 400 million. And it was moved for less than $2.38. And it took 15 minutes to do the transaction. Most importantly, no bank, government, or third party actually had any reason to verify that transaction, nor could they have stopped it. So put that into perspective. But me personally, blockchain technology is key. I actually do a lot of capital raising for a few seed companies, and one of them I'm working with at the moment is a blockchain company that, if it becomes global, it's already really started to be taken into adoption by a lot of the big institutions, investment banks, retail banks, high street banks, infrastructure in the financial sector, strategical payment systems, etc., etc., etc. If it comes global, it is a game changer. And I'm still raising capital for that. Again, it's not a plug. Next seed capital is about 50 million in raising. So it's looking great. It's got great legs, and it's working with some of the biggest, most established financial institutions in the world that each and every one of us in this room will have come across. So going back to the understanding who we are and mindset. So this is how we as traders initially think. We're always looking at indicators as we put most precedent on them. The entries and indicators, I mean moving averages, the Holy Grail, MACDs, RVIs, RSIs, stochastics, pivot points, Bollinger Bands, Ishimoku's, etc., etc., etc. And then they move into stop loss and trade management. But look at the biggest part of that pie chart there, entries and indicators. But really how trading works is entries, continuous learning, trade management, risk management, exits, and stop loss. A lot more onus and a lot more importance has been put on continuous learning, trade management, and risk management, guys. So please bear that in mind. And just before we really start to delve in, we have to go through the disclaimer, which is the boring stuff, guys. I know this information has been produced by Intelligent Trading Academy for general information and advice purposes only. It's not indicative of future results. ATFX does not take any responsibility for the accuracy or completeness. Any opinions expressed by myself do not reflect those of ATFX UK. This information does not take into account any of your personal circumstances or objectives, and therefore should not be interpreted as financial, investment, or other advice, or applied upon as such. You should seek independent advice before making investment decisions. Reproduction of this information is whole or in part is not permitted. And finally, the risk warning. Since ESMA and the FCA and the Financial Services Compensation Scheme have come in place, which is a great, well, they're 3 great projects and 3 great corporations for the retail sector. CFDs are complex instruments, or can be complex instruments, and come with a high risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading CFDs with ATFX. You should consider whether you understand how CFDs or spread betting work and whether you can afford to take the high risk of losing money. Now, one of the reasons ITA have teamed up with ATFX is because 72% of their clients before ITA started working with them were losing money. My goal and my business partner's goal and ITA's goal globally, is to reduce the amount of traders that are losing money in the financial market by trading professionally, correctly, with the right people and right guidance. I will show you that our community are making roughly 5 to 15% per month, and I'll show you a couple of the open trades that we've got on right now. Yes, I'll show you the whole account so you can see it. But the reason we got involved, now just to give you an idea, Adrian and I started trading principal only funds about 2014 as a team together in the office. Over that 2-year period, we've got quite a lot of organic footfall, individuals approaching us. What do you do? How do you do it? Can you teach me? That organic growth created an opportunity for us to stem and develop and extend our passion. So my passion and Adrian's passion is the financial markets. Our purpose is to give back. That's where ITA was born. As traders, we're very relaxed, we're very comfortable, and bearing in mind we only take roughly, my strategy about 10 trades a month, Adrian's strategy about 20 trades a month. So we're not very, very, very active in the markets. So we have time. So an additional revenue and additional business development and opportunity arose, which has then adopted into additional revenue streams for raising capital for big companies like the blockchain company, like aerospace industries, like algorithms, like artificial intelligence. And these companies could change the world realistically from not only the financial services infrastructure, but the defense sector. So, you know, business opportunities come from networking and surrounding yourself with other like-minded successful people. So that's the boring bit done, guys. Let's get into it. Vasco, if you wanna have a chat about what companies I'm raising for, unfortunately, buddy, we have to sign an NDA, non-disclosure agreement. These companies aren't actually readily available for retail at the present moment. Funding is primarily restricted to high net worths and institutional because it's seed capital. Minimum investment is £1 million sterling. So not trying to write you off, Vasco, buddy. If you have that kind of capital assets, please feel free to get in contact with us, and I'll obviously more than happy to provide you with an NDA and come into the office in London by St Catherine's Dock, and we can have a coffee and a chat about it with my business partner, Adrian. So let's delve deeper into chart patterns. Chart patterns are considered one of the most effective trading tools within a trader's armory, especially within the ITA community. Chart patterns will continuously repeat themselves in the market time and time again, and once understood are relatively easy to spot. So what I like to say is once you have seen them, it becomes very hard to unsee them. But one important lesson, note, and keynote to take away from this is just because there's a pattern in the market doesn't necessarily mean you should trade it. There's a difference between a valid pattern and a high probability setup or high probability pattern. And within the ITA community, we tell and show you how to establish that, distinguish it, and understand the differences between that. The greatest thing is chart patterns are actually formed of pure price action, and they form on the basis of underlying bullish or bearish price action or pressure. The greatest thing as well is we evolve with the market conditions and we adapt with the ever-changing underlying conditions of the financial market. So we, as a community, we use chart patterns as our manual analysis to identify the continuation or reversal signals to execute our trades and identify not only areas to get in, but potential price targets through forecasting. Very key. So once we've established our entry and our risk, we then look for probable areas that we can place our price targets. And of course, we will actively manage our risk accordingly, utilizing the break-even methodology where we move our stops to break even accordingly when our trade is open and running. I've actually wrote a book which is called the ITA Chart Pattern Blueprint that I give out to all of our community, and each and every one of you will have the opportunity of picking up that book later this evening, so please stick about. On the book and in the book, I focus specifically on the most common patterns utilized within the community, and that blueprint should be your pattern that provides you with the patterns you should be keeping an eye out for as you continue your journey throughout the content and becoming a consistently profitable trader within the market, within our community. So, a couple of snippets from the books and some of the biggest market structures and patterns before I delve into the charts and try and spot some with you. And bearing in mind, no chart pattern is ever going to be textbook. So if you see a bullish equidistant channel, a bearish equidistant channel, so an ascending or descending channel, so ascending, descending, but of course these are in the formations of continuation patterns, and I'll delve deeper into those in a second. So we have the bullish and bearish flags in front of us. So bullish and bearish flags, again, just because they appear in the market doesn't necessarily mean that they're higher probability. And this is where your back testing will really come into play and come into its world of its own and kick in. Every currency pair will have different characteristics of how it reacts to a different market structure, a different pattern. So by looking and understanding and back testing each currency pair, you will understand the success strike rate of a bullish and bearish flag, as well as the failure of a bullish and bearish flag. So once you've kind of understood the back testing and picked that all up, you should be able to spot opportunity. So let's just say the Australian dollar was setting up for a bearish flag continuation pattern. But we knew 70% of the time a bearish flag in the Aussie USD fails, i.e. we get stopped out for break even or -1% 70% of the time. And this is a question for all of you guys, so I look forward to your answers. If a bearish flag on the Aussie USD fails 70% of the time, would we still take it short? Go. Okay, so some good answers coming in straight away. Correct. No, however, 80% of the time we want to focus on high probability setups, whilst 20% of the time we focus on valid setups. Yes, 70% of the time we're potentially going to be struck out or off the break even. But if you're executing your trade, so it's quite subjective. Realistically, the answer is no. But if 80% of the time you're taking high probability setups that are running at 4 to 1, 5 to 1, 6 to 1 risk reward ratios or more, 10 to 1, 15 to 1, even 20 to 1 we've seen in the US dollar CAD and US oil over the last 6 months in 2 trades alone. You can take that style of trade, but realistically, you're not going to. So it's always best to not take that style of trade, but forecast and watch it, how it works. Because then when you conduct your own ASR, so your advanced self-review, and your next set of tweaking and backtesting, you can then review the backtesting results and your ASR results and your forecasting results against the Aussie dollar bearish flag to see if the statistics have changed. If they have, then you may start incorporating that particular market into your bearish flag continuation rulebook. But realistically, if something fails 70% of the time and it doesn't have a high strike rate or risk to reward ratio, you don't trade it. Statistically, if you take 100 trades in a year and your risk to reward ratio is 5 reward, 1 risk, so 5% reward, 1% risk, you only need to make 20 winning / successful trades a year at that reward to risk ratio to make money. So you can lose 80 trades and still make money from the 20 trades as long as your risk to reward ratio is greater than 5 to 1. So that is another important point. As long as your risk to reward ratio is at least 5 to 1, you can make consistently profitable returns in the financial marketplace, even if you lose 80% of your trades. I hope that's nice and easy for you to understand, guys. So continuation patterns. Now, continuation patterns are the bread and butter of my scaling. So I'm already in a particular trade and the market's starting to correct. I'm either looking for an option to get into the market for my first trade, or I'm looking for an opportunity to scale into the trade. So this is where bullish and bearish flag patterns come into play. Now, there are more continuation patterns, and yes, there's a difference between a valid flag and a high probability flag, but those are the sorts of things you will learn during the ITA community in 6 months experience. So these patterns are formations that show sideways price action, so corrective nature. They show a phase or period of distribution in the trend where price consolidates after a bullish or bearish move. The formation in particular of the continuation patterns is known to be complete after price action breaks out and continues in the direction of the prevailing trend. So impulse, prevailing trend, correction, breakout to the upside. Impulse, prevailing trend, correction, impulse to the downside. Now, another question for all of you that are listening and watching. If I'm trading a bullish or bearish flag formation, let's say I get in here, what's my price projection, forecast, and target based on traditional flag patterns? Depending on your risk to reward ratio, Stephen, if you can get at least a 2-to-1, 3-to-1 risk reward ratio by having your risk, your stop loss, just inside the continuation pattern, so inside the flag. So if you could have your stop just inside the market structure and you're going for 1/3 of the pole, then that may be so. However, the true or textbook answer is your projection forecast for your target is the length of the flagpole. So for example, I would copy this and I'd paste it from there to there, and that's where I'd be looking to place my price target. Now, yes, you can place it at the absolute low of that projection. However, we all know that markets, if they're in a corrective manner, can create higher lows or lower highs. So it's always best to place it slightly above that area. Now, there's actually 2 ways within the ITA community that we will get into a bullish or bearish flag. So yes, there is, well, actually there's 3, but there's 2 that we use. I'll go through the 3. One of them is the first, which is an impulsive breakout to the downside, and you're setting an order into the market to get you in. That actually removes ambiguity and emotion, so it'll actively get you in automatically if you've already set that sell stop in this case, or buy stop in this case. The second method, which is another route in, is a breakout of that, retest back into the level. So old support turns into new resistance, old resistance turns into new support, retest at that level and goes. The third way is at the top of market structure and the bottom of market structure and a bullish flag. So, and this is obviously what we'll teach you. Moving nicely on to expanding wedge formations. Now, expanding wedge formations are found both in continuation markets, both in bullish and bearish scenarios, and they're also found at reversals as well. So it depends on where they appear in the marketplace, and that then of course determines how you should trade them. So expanding wedges can either be bullish or bearish, and of course they depend on where and how they form within an existing trend. The formation comes when price is holding between 2 diverging trend lines, and that trend lines create the framework of the ITA community structures. The upper line is resistance and the lower line is support. So support, resistance, resistance, support. Okay, guys? Ascending and rising wedges. Now, ascending and rising wedges, in particular, yes, they are commonly used within the ITA community, but the majority of the time we tend to find the better evolvement with an ascending or descending wedge, like an ascending or descending channel like these 2 in front of you. Equidistant ascending channel, equidistant descending channel, okay? So they'll always look like this at first, and the reason that is because price is tightening. And if it's at the top of a bullish trend and it's doing this in a very, very corrective manner, then this is where we're looking to get short. Herd mentality, if we're trading horizontal support and resistance levels, and the resistance level we break new highs, herd mentality, the majority of people are going to be looking to get long. But it's not that it's broken and made all-time highs that means you should be getting long. It's how it breaks that level. So I hope that note stays with you forever, okay? So ascending wedges, that particular pattern is traditionally and typically known as a bullish continuation pattern, whilst price remains inside the rising wedge. However, within the ITA community, we can utilize this as well as a potential reversal pattern. So that's what I look for majority of the time. An ascending and rising wedge in a downward trend is considered bearish. The ITA community view an ascending rising wedge in a bullish trend as a potential reversal pattern, signaling a reversal in market cyclicity and the direction of the trend. So we believe there could be a change in the trend. One of the greatest hedge fund managers out there, Paul Tudor Jones, multi-billion dollar fund manager. If you haven't seen his documentary, please visit YouTube. But Paul Tudor Jones is one of my greatest traders. He says the majority and the most amount of money can be made at turning points in the markets. Now, I'm not saying that we catch the bottoms or pick the tops, because catching a falling knife and picking the, catching a falling knife can end nastily, and picking bottoms can end up with smelly hands. So we don't want, of course, green fingers from the gardens. However, if the market's changed and we can establish that through all of our notions and all of our levels and structures, gives us a high reward to risk ratio. So high probability setups, reducing our risk, increasing our upside. Now, 5 to 15% a month is really achievable once you really get to understand how we trade. I have seen some traders do 30% in a month, 20% in a single trade, and 60% a quarter. And it's so, it does happen. And the greatest thing is we're a community that enhances your journey. 40 plus years financial market experience. So I'm hoping that you can extract as much value from both Adrian and myself, as well as our European education and mentoring session that's company that's run by Wolfgang Habereder, who's increases our experience, who's actually one of our own, initially one of it, well, he joined our community, but he was also a financial advisor. So he brings a lot to the table. Credibility, reputation, experience, all three of us have it in the bag, let alone our South Africa office as well. So the descending wedge, very similar to the ascending wedge, guys. Whilst price action remains in the channel or the wedge, it's a bearish momentum to the downside. We do, of course, have opportunities within that on the lower degree, but we're looking at this to spot possible reversals. So bearish trend cycle reverses into a bullish trend. So that's what we look for. And again, just to summarize, both the ascending and descending wedge patterns are commonly used within the ITA community, creating opportunities to get long, i.e. buy, or go short, which is known as sell, based on price action approaching the market structures. Now, one of the favorite and best structures, bullish and bearish equidistant ascending, descending channels. So typically and commonly known as continuation patterns within the uptrend in the terms of a bullish channel. The ITA community will also view this as a reversal pattern. Elaborating even further, an ascending channel in an uptrend for the ITA community is utilized as both a bullish continuation and bearish reversal pattern subject to the time frame. So I will be looking for bullish moves in here, whilst focusing on the bigger picture where I'm looking for a short, as well as the community. Now, we've taught over 250 plus individuals to trade. 97% of our traders are all making money, and none of our clients have ever blown up their accounts. Statistics speak volumes, experience and actions speak even louder. We at the ITA community, the ascending channel can be used as a reversal pattern, allowing us to potentially capitalize on large risk to reward setups based on our trading strategies, risk management and entry types, i.e. execution. And the same will apply for descending channels, okay? So reversal patterns, we'll of course be looking for not only bearish continuations within the pattern, but we'll also be looking for a bullish reversal of the pattern, subject to the time frame and the overall market direction and structure. So that's how we do it, guys. But guys, let's delve in, if I can, to the charts, and let's see if together we can spot some opportunities. So I'll always start on the DXY. It's pretty much my go-to chart every weekend. I'm actually bearish the US dollar long term. So primarily at the moment, I'm looking for opportunities for the market to come higher, where I'll be looking for shorts. So if we actually look on the daily, and actually let's delve out even further. So I do top-down analysis, guys. So let's look at the weekly time frame. I'm looking for one more move down to the 61 level. So if we get that from here, that is crazy, but it can happen. Look at this, 2008 global financial crisis, pretty much when I actually started working the city, 71, 95, 80, 92, 77. So it's not unbeknown that the market could get down here. And no, it's not going to happen overnight. That took from 01 to 08 to get down there, really. And it took from 08 to 17 to get back up. So this won't happen overnight. What it's realistically going to do is come up, correct, 2025, which if we look at the life cycle of a bullish and bearish market, typically bullish markets and bull cycles last anywhere between 9 and 11 years. We're actually in the 11th year right now. Yes, we've got Brexit ongoing, and I'm not going to get into that particular scenario, but we are already in an economic global slowdown. If we look at global economics, the world is slowing down. Demand in Asia is slowing down. Demand in the US is slowing down. House prices in the UK are falling, allegedly at their fastest pace in 10 years. But don't worry, not every district of the capital is a loser, of course. And bearing in mind, some areas won't fall as quickly as London, and smart investors get opportunities. And the greatest thing about another crisis is investors will get even more opportunity to buy a property. I've bought a lot of my property at 15 to 20% below market value, and then I've actually bought some at about 30 to 40% below market value, and I've fully renovated to increase the threshold of the street. So, you know, most recent property, 360,000 I purchased for, and the average on the street is about 700,000. Renovation costs about 50 to 75 grand. So decent market value. So, you know, just looking at it from a global financial crisis, I can actually, based on the valuation, I can afford for the property prices to come down. And a lot of you guys will have decent equity to loan values, will have very decent interest rates, will have paid off a decent amount of your mortgage. Some of you may not even have mortgages. Just to clarify, I do think mortgages are the biggest government scam going, but that's a topic for another evening. What I mean by that is the mortgage is the liability, and until you pay that property off, of course, it's not yours. The asset is the property. So yes, if you can get the asset at the right price, you'll have that asset subject to being able to pay it off. But what it does do, hence why it's the one I consider one of the biggest scams, the liability is the mortgage, and it keeps you in the rat race. So you have to be in the government cycle of paying tax until realistically you can pay off your mortgage. So average of 25 to 35 years. Some are even doing 40 years now with 95 to 100% loan to value. That's one of the biggest reasons we can't, as a UK economy, afford to increase rates, interest rates, because we're on a generation of low interest. So that means if we increase the rates, we're going to have more in the UK defaults, which in the US is known as foreclosures, which would then in turn mean a lot more people fail on their mortgage and their debts. You look at personal debt to ratios in terms of credit cards, car finance, mortgage finance. That will send financial companies, big institutions, big tier 1 banks down the drain. And we can't afford that. The government will not be able to bail out the UK economy, let alone the global economy. You know, it's crazier in other countries if you look at the economics. happy to provide you with some indicators on economics. I've got an A-level in economics, so please feel free to shout me on that one. And I'm a qualified technical analyst and economic from CISI. So yeah, the US dollar on the weekly, look at that. But if we actually delve down into the daily, I've been calling a lot of opportunities short for a while now, and I'm looking for one more push to the upside. The most highest probability is the outer structure, which is up here at the 100 big round number. If we can get to the outer structure around 99, yeah, realistically, I'm going to be looking to take that short. But we keep playing inside here, and I'll delve down into the 4 hour to show you guys. We've had some really great opportunities. We had a nice short here. We started to see this running channel, which was actually the phase for me of a correction. So I was really liking the look of that. We really had this nice ascending channel within a confirmed second touch to the downside. We've got that 1, 2, 3 touch move to the downside, which is going to create that third touch here. And then we could see the US dollar strengthen either one more time to the outer structure there, or go all the way up to the big 100 round number. That will get a lot of people caught on the wrong side of the trade. A lot of people that get a fear of missing out are already selling the dollar. More patient investors and traders are waiting for these big round numbers. And then, of course, you're going to get a lot of people buying when it breaks the high. The best we can see is wait for that to break the high. Herd mentality will get long, even if it breaks out in a corrective fashion. If it breaks out in a corrective fashion, I'm taking it short. So just understand the way my mind looks at it. Whilst everyone else is getting long, and these are things that normal retail punters and brokers show. ATFX are very good at helping you and giving you the guidance, and that's why they brought in independent educators like ITA to assist their global client base with the values and work with people that are in close alignment with them, making sure that they work with people that have got good reputations, good accreditations, have got real quality of professional career history, and are interested in driving down the loss ratio of retail clients. But delving into that, a lot of brokers even show how many people are long a particular asset class. People get sucked into that. If the herd, the sheep, are all long, you don't necessarily want to be long. You want to be taking the other side of that position at value areas, and that's what the ITA community teach you, hence why the statistics and figures speak for themselves, and that's why we're here. So guys, you can see on the dollar index, we've got a really nice bullish equidistant channel. We've had a breakout to the downside and a move back into the structure. Yes, I can actually evolve this structure now to make it slightly wider, meaning we've got 1, 2, and we're now looking for that one more touch to the upside, let's say around this value area here. And then we're going to be looking initially for a short to the completion of the pattern, a correction of that pattern there to 93. If we can get down there impulsively, there will be a few corrections on the way, but this is where I'll be looking for the overall shorts to the downside. So first to the double bottom at 88, and then all the way down to the 85 handle. I do then expect it to come back up before actually getting down to that massive value level at 62. But guys, really, really nice opportunities are shaping up. So does anyone that's here this evening focus on market structure, the nature of the market, or price action? Or does anyone want me to delve even deeper into structures at all? I hope I'm pronouncing this correct. Yijit, with the G being silent. What in particular would you like me to show? Would you like me to delve into the differences between what I'd consider as a valid setup and a high quality setup, a high probability, and what the possibilities versus the probabilities are? Or are you having trouble spotting patterns in general? They tend to be quite hard to spot at first, but once you see them, you won't be able to unsee them. So I'm happy to really go into that if you want me to. But please, let's fire some questions over, questions and answers. Let's have 10-15 minutes worth of questions and I'm happy to answer them. So fire your questions away, guys, at your disposal. So how do we draw market structures, guys? So I look at the two most recent and prominent touches. So if I actually go up here to a nice blank screen, if markets are impulsively moving like this, initially I'm going to be looking at this kind of move here. Let me clean this up. I'm going to be looking at like something like this on the outer structures, and then when I delve into the lower time frames, such as the 4 hour and the 1 hour, I'm then going to in turn be looking at how the structures are made up. Are there any high probability set up inside this? So that's not considered one. This strategy in particular, Stephen, we don't actually use moving averages or any indicators, be it oscillators, laggard indicators, like obviously oscillators and indicators such as MACD, RSI, RBI stochastics. I actually trade purely using market structures, momentum, i.e. price action, and the nature. I do take note of the 200 exponential moving average, primarily because it's the last hope for bulls or bears in the prevailing trend, and institutionally it's followed by everyone. But I find that horizontal support and resistance levels and moving averages are very subjective, and too many people put too much precedent and weight on them. You know, a lot of traders use 21, 50, 75, 100, 200 EMAs. Two of our other trading strategies are based on momentum, and yes, we do use moving averages. One of them uses 3 moving averages, all exponential, and the other uses 2, and they are absolutely on fire. But too many people utilize moving averages in isolation. The key is to use them in partnership and alongside other highly regarded trading techniques. So confirmation signals are, for me, Gigi, they're a combination of all three. So I'm a multi-time frame analysis, so I do top-down analysis. I then use market structures all the way down, and then I'm looking at the nature of the market, how it approaches particular levels, and then the price action is realistically my key determined area of entry. So if I actually bring euro sterling up, which was a trade that I've been following since early this week, and I actually missed it earlier today, the daily structure is this. So daily structure for me does want to go higher one more time up to the 1.08 handle. However, if we move down into the lower degree on the daily, and see here, we had this expanding wedge formation around the triple top. So we had a really nice impulse move up following the second touch, and we had this very, very corrective price action all the way through. Now, my biggest risk to reward ratio is around the 91 level here, which would have created that kind of triple top area. But if I then delve deeper into the 4 hour and 1 hour, I started to see these swing highs being rejected, and this is actually where I wanted to get short, around this value area here. for about kind of like a 45-50 pip stop on the 1 hour time frame, so just outside the market structure. To the low of the pattern, we had a decent 1.8%, and if we break that impulsively just on that entry, we've got to move all the way to the downside for just over 6%. Now, I didn't get in this trade, guys, so I'm not in that. What I am going to be looking for is a bearish correction. So bearish correction for me would have to be either a move back into the level correctively and then go. Alternatively, I'm going to be looking for a bearish flag continuation. And depending on how it sets up, I'm going to be looking for that short. So there are a few things for me that I have to get in before I actually take a trade. But yeah, they all kind of come together. Smarty, it's actually a combination, so great question. Simplest way to detect the trend reversal on the chart. Now, it's never going to be 100% strike rate. Yes, it's inevitable. Every trader loses. We take losing trades, but as long as our reward to risk ratio is better than our losing ratio in terms of the money we risk, we'll always be consistently profitable. So I do take losses, and I'm not afraid to admit that. It's part of the business. If I set up a supermarket or a shop, I have to pay rates, employees, stock, electricity, accessories, maintenance, everything, materials, systems, payment gateways, payment systems, etc. If I'm a trader, what do I pay to the market? My material and equipment costs, electricity, realistically, and the losses into the market. So 1% risk per trade should be suffice. So the simplest way for me is utilizing all three: market structure, nature, price action. I then put each three into play, and then of course I wait for that particular area and value area and high probability area or valid area to take the short or long. Abina, so I actually do multi-time frame analysis. So I do top-down analysis. So I look at the monthly, the weekly, the daily is where I spend most of my time, and then the 4 hour and the 1 hour, they're for executions. I have incorporated the 15-minute into that, but realistically the 1 hour is where I execute, the daily is where I spend most of my time. And the majority of our community all have full-time jobs, be it businesses, full-time working positions and employment. They all trade the same way, and they're doing fantastic. I did use it. So the importance of how it breaks. So it has to, if it breaks impulsively, then I'm not going to get in front of that. If it breaks correctively, then I'll be watching for exhaustion, unsustainable momentum into the direction of where it broke, and I'll be looking for an opportunity to take it short. And that's the game of zero-sum game. So I hope that answers that question. Moving averages are subjective. The 200 exponential moving average is pretty much the last stand for bull or bears in the prevailing trend. Of course, people do bring in faster moving averages, and they use them for different reasons, be it to get into the moving average crosses and obviously interact those with other technical analysis levels and methodologies like our other strategies do. Some of them just purely use them for support and resistance levels to ride a prevailing trend. Some of them will obviously focus shorter term moving averages to establish whether there are opportunities or moving to the downside. Like I said, the 200 EMA is pretty much the last stand. I don't actually look at volume, in particular in FX. It's very hard to understand volume and liquidity because the transaction sizes aren't just for FX purposes. You know, we've got currency hedging ratios, we've got business transactions, we've got economic import-export transactions, and of course currency conversions going on. Volume primarily and ideally, I have used it, and I do use it for mainly equities in terms of breaks. If I'm looking at breakout trading and continuations to the upside, or the way I trade in FX and commodities, I do use volume in stocks. So equities, be it FTSE 100, 250, 350, ASX 200, the Dow, the S&P, the DAX, the NASDAQ, the CAC, etc., etc., etc. So volume in stocks and equities, definitely well worth a look. But guys, I really hope, obviously, you know, that answers all of your questions. So this evening, ATFX and ITA have actually partnered up together, and we're going to be offering every one of you, and realistically the first 5 to 10 people, an exclusive limited webinar offer. Usually we offer 3 months education partnership, which we're going to be giving 6 months away. We give you access to all of our trading strategies, the 40+ years experience that Adrian and I have got, unlimited access to our midweek market reviews, which are sent out to you in the day of a Wednesday. So you've got those for unlimited lifetime access as long as you download them. We send out weekly and daily market analysis. We send you out trade ideas, trade signals, including chart analysis and breakdowns. You get access to our Pro Trader Skype chat, where our whole community, and we roll roughly about 50 to 60 clients at any one time. So you get access to all of our community. You get trader email correspondence, and you get an online or face-to-face individual assessment and setup session. And of course, you can have individual coaching sessions as well. Now, today's offer is going to be for 6 months education. You're also going to get the book, one of the books I wrote, which is the Ultimate Forex Trading Guide Foundation Series Volume 1 in PDF. You're going to be getting the Chart Pattern Blueprint, which is the other book that I've wrote and I mentioned earlier today. And you're also going to be getting a trading journal template and Excel spreadsheet that's formulated and rules so that you can keep track and log every single one of your trades, so that when I do an assessment with you, we can see where you're going wrong and how you can tweak it to make it better. Now, originally 3 months, you're getting it for 6. You get the 2 bonus books, the Ultimate Forex Trading Guide and the Chart Pattern Blueprint PDF. Originally, it's $2,995 plus the VAT. However, for today and the next 24 hours, you get all of it for £595, including VAT. It's an exclusive limited offer, and if you are interested, I'm dropping a link into the chat room right now. Click on that and you can sign up today for the 6 months offer for the total price of £595, including the VAT, guys. And if you are interested, drop a yes into the chat box or follow that link and get yourself enrolled, because it's only going to be open for the next 24 hours. Then it's going to go back up to the original price of over £3,000 for 3 months alone. I hope obviously you've enjoyed yourselves this evening. ATFX are our partners. They've actually been awarded the best Forex CFD broker in the UK for 2018. They're fully FCA regulated. They're part of the Financial Services Compensation Scheme, which means that your money is protected. Their funds are held in segregated accounts, so your funds are fully protected. Fast and safe deposits and withdrawals. Their liquidity providers are obviously big institutions, tier 1 investment banks such as Barclays, Goldman Sachs, and they have a dedicated customer service representative, which is David Berg, who we work closely with, who's a top guy. This is myself sitting in front of the screens in our office before the restructure and growth, and that's where we're based. Level 8, 3 Thomas More Square, London, Echo 1 Whiskey, 1 Yankee Whiskey. But for those of you, well done, who have actually enrolled into the 6-month program. I can see your orders coming through now. For those of you like Stephen who have just obviously put Y into the chat box, we'll be in touch within the next 24 hours to go through a bit more of your questions. But thank you very much. There's 7 of you so far that have signed up. Really, really appreciate that. John, Bill, Vladimir, Annette, congratulations. We look forward to working with you, and I will be speaking to you in the next 24 hours just to go over the enrollment process and the real structures. And of course, I'll get emails sent out to you in the morning as well. But thank you very much for everyone that's turned up. I really hope you've managed to extract enough value from me this evening. And I look forward to seeing you within the community and hopefully working with us in the near future. So guys, have a wonderful evening. Remember to spend it with your friends and family, and good luck.